Hi, I'm Nadine Terman. Welcome to 2023. We're going to walk through a key item we're looking at this morning. I'm sure many of you are as well, as you're trying to risk manage what's happening on the first U.S. trading day of 2023. We really think it's about inflation and growth. No surprise here. So inflation, it's declining, but how fast and to what level? Growth is declining, how fast and to what level? And that really gets into the question of, like, is the 2023 market going to be about rate sensitivity or earnings and cash flow trends? And then relatedly, credit. We're looking at something that UBS put out this morning, and that kind of tells you, encapsulates the difference between what could drive the market. They're saying, oh, if it's low growth and high inflation, the S&P would be at 3,200. But if it's okay growth and low inflation, wow, we're going to get to 4,300. Well, that's a pretty big level of difference. So how do you think about it? Again, we also look at expectations. How do you be non-consensus? So you're looking at inflation, looking at growth, also look at expectations. Most folks, if you're reading, and I've been reading the last few weeks, they have their worry hats on for the first half. And then they're saying, okay, but then the second half, there's going to be a rebound. So if consensus is on that path, it's most likely not going to happen that way. So just remember that if you're going to be non-consensus, well, that's the consensus play. So what do we do about it? Well, when you know growth is slowing and when you know that rates could really change depending on inflation, labor, what the Fed's doing, what's happening internationally, one way to do well is to stick with quality. And so right now, when we looked at historical periods, there's been about a 15% return differential between high quality and low quality during recessions. So if you're thinking that the growth is going to slow and we're going to see that slowdown, that's a good place to start to look for high quality. And then also relative valuations in quality right now, about 25% cheaper to the typical end of cycle levels. And obviously, we're not at the beginning of a cycle. We're at the tail end here of the cycle. Other thing to think about for the year is large versus small. I know a lot of people get excited about small caps. That's usually when the rebound's happening and you can play cyclical plays. People might be getting excited about China, but we would express a caution right now. Small caps have a much tougher time with cash flow metrics. They usually get hit harder on floating debt, and rates are still going up. The Fed's been very, very clear about that. And then value. I know people love to hang out in value. They want to, stick with that thinking it's going to take them through, but it really depends on financial conditions. You need dividend growth, and we've talked to our investors about that, and we've written a little bit about that to you too. And we don't expect that to be a good driver of returns this year. So you have to stick with those businesses if you are hanging out in value that have dividends, but also will keep and hopefully grow those dividends, not cut them. So you need to have strong free cash flow and to have one of those strong dividend leaders in the value bucket. And lastly, momentum. Oftentimes you actually can play momentum in deflationary periods, but be careful because it's had a run in the past part of this year. So we would be more careful looking in momentum versus quality right now. Quality is a bit less loved. So that's number one, looking for those that are the least loved qualities. So don't try to pick the ones everyone's picking. Cheap defensives over expensive cyclicals, looking for that true dividend yield and growth in the dividends. And those stocks or assets that have recession already baked in. Some people kind of knew early on that they're going to have a hard time through them out. Maybe look at those to pick up. They shouldn't be a huge part of your portfolio, but it's somewhere to look if you want to add a little alpha. But be careful because we're going to go from a liquidity downturn to that credit cycle downturn. And I know that China's been thrown in the mix here, but there's a lot of wood to chop. We would need China really to show fiscal and monetary support before we would get full on excited about China and then other EM. And the other area, which will, I guess, spoiler alert, we'll come back to another day, is the US dollar. But if I'm going to take a look at Longbow and some of the items that we mentioned, maybe played this year, I'm looking at quality. Let's just take a look, because all of these right now, you've got momentum oversold, the dollar over BART, but I'm talking about quality. So this is just a quality ETF. But if I'm looking here, where are we? Well, it's been, obviously December was a down month. And you can see that the trading range is actually narrowed. So right now, it's short-term and medium-term bearish. So this isn't the time you go plowing into the markets. But again, if you have to be long or picking longs against short, you want to be more into quality. Coming back to there, again, it's not the lower end of its trading range and it's neutral right now. But the odds are to the upside versus the downside. So you can keep watching this one. And that's going to be versus something like value. So if you take a look at value, that's more in the middle of the range. Obviously had a big run up and then came down in December. The trading range is narrowed there as well. Bearish for momentum indicators, short term and intermediate term. But again, be careful on these guys. But those are the two. If you're going to be watching, here's the ETFs. We look at quality, defensive, momentum, value. This is just SPY overall. And then the dollar, which we'll come back to another day. But again, this kind of mimics what you saw. You see trading ranges being narrowed here at the end of the year. Volumes were down. So you might also expect those trading ranges to go up. So nothing to do quite here today. I wouldn't play momentum, even though it's oversold today. But take a look for 2023, your portfolio, some of the factors that I mentioned, and make sure you're just positioned right so that you're not caught off guard again in case that happened to you in 2022. Have a good day and talk to you tomorrow.